Transfer pricing is a critical concept in multinational enterprise taxation. It refers to the pricing of goods, services, or intangibles transferred between related entities within the same corporate structure. To ensure that prices between related parties reflect an arm's length principle, that is, the price that would be charged between independent, unrelated parties, organizations use specific transfer pricing methods. Selecting the right method and documenting it accurately is key to maintaining compliance and optimizing tax positioning. The Organization for Economic Cooperation and Development provides guidelines on 5 main transfer pricing methods, each with distinct advantages, limitations, and applicability. The cup method is one of the most direct ways to determine an arm's length price. It compares the price charged in a controlled transaction between related parties to the price charged in a similar uncontrolled transaction between independent parties under similar circumstances. If a closely comparable transaction exists, this method can be highly reliable as it directly benchmarks a price against the market standard. Applicability and challenges. The cup method is most effective when there is a high degree of similarity between the controlled and uncontrolled transactions. However, finding an uncontrolled transaction that is sufficiently comparable can be challenging, especially if the product or service is unique or has specific terms that aren't mirrored in external market transactions. The resale price method works by looking at the price at which a product purchased from a related entity is resold to an independent party. From this resale price, an appropriate gross margin is subtracted to establish the transfer price. This margin represents the amount required to cover the reseller's operating expenses and provide a reasonable profit, consistent with what an independent party would earn. Applicability and challenges. This method is particularly suitable when the reseller in the transaction is simply distributing the product and not adding substantial value, e.g., through complex manufacturing or processing. For this method to be reliable, there should be a clear link between the resale price and the transfer price, which might not hold in cases where significant value is added in the resale phase. The cost-plus method calculates the transfer price by adding an appropriate markup to the supplier's production costs. The markup reflects the gross profit that an independent supplier would earn for comparable goods or services in a similar transaction. This method is often applied in cases involving semi-finished goods, assembly services, or when related entities have long-term agreements to supply products to each other. Applicability and challenges. This method can be particularly useful in manufacturing settings or with long-term intercompany supply arrangements. The challenge lies in accurately determining the plus component, or markup, as it must be comparable to what an independent party would charge. Availability of reliable data on comparable gross margins is essential for accurate application. The Transactional Net Margin Method compares the net profit margin earned by a related entity in a controlled transaction with the net profit margins earned by independent companies in similar transactions. Unlike the cup method or cost-plus methods, which focus on gross profits or direct price comparisons, the TNMM considers the profitability of the transaction as a whole relative to an appropriate base, such as costs, sales, or assets. Applicability and challenges. The TNMM is typically used when traditional methods, like cup or resale price, are less applicable, such as in service transactions or cases with limited comparables. This method requires careful selection of the net profit indicator, and its reliability depends heavily on the degree of comparability between the controlled and independent transactions. The profit split method allocates the combined profits from a controlled transaction between related entities based on an economically sound allocation key. This approach works well in highly integrated operations, where each entity's contributions are difficult to isolate, such as in joint R&D ventures or scenarios with unique intangibles. Applicability and challenges. The profit split method is particularly useful in situations where a simple comparison of prices or margins does not reflect the economic reality, such as in cases of joint intellectual property development. This method, however, requires in-depth analysis of each party's contribution to profits, which can be complex and resource-intensive to determine. Choosing the appropriate method depends on factors like transaction type, availability of comparable data, and the degree of integration between entities. Documentation is critical, as it establishes the rationale for the chosen method and demonstrates compliance with local tax authorities. In practice, the OECD encourages the use of the most appropriate method based on the specific context, rather than a one-size-fits-all approach. Transfer pricing compliance is a key aspect of international tax law, requiring MNEs to carefully analyze their transactions and justify their pricing methods. The 5 main OECD-endorsed methods provide diverse options that MNEs can use depending on their structure and the nature of transactions. Each method offers a different lens for viewing arm's-length pricing, allowing organizations to select an approach that aligns with their operational realities while satisfying regulatory requirements.